Welcome to the Fintech One-on-One podcast. This is Peter Renton, chairman and co-founder of Fintech Nexus. I've been doing these shows since 2013, which makes this the longest running one-on-one interview show in all of Fintech. Thank you for joining me on this journey. If you like this podcast, you should check out our sister shows, Pitch It, the Fintech Startups podcast with Todd Anderson, and Fintech Coffee Break with Isabel Castro. Or you can listen to everything we produce by subscribing to the Fintech Nexus podcast channel. Welcome to the podcast, Max.
Thank you for having me.
My pleasure. So let's get started. I want to go back to the early days of Affirm. In fact, before you even founded Affirm, what was the idea that you really had? What was the catalyst for the idea for the founding of Affirm?
So one of my then Affirm co-founders, who happened to be a very close collaborator of mine at PayPal, he and I worked together quite a lot on fraud. We were friends since high school and stayed in touch all through PayPal. And after, we were having sort of this series of lunches discussing the world of fintech, and sort of chanced this idea that we worked so hard on creating these really interesting scores to figure out if someone was fraudulent or not. And yet we never dipped our toes, so to say, into figuring out credit worthiness, which is not an exactly the same problem at all. Kind of similarly, you can intuit that a score might be designed using data sources that are not kind of your standard FICO score type thing to figure out credit worthiness, especially for people like us. So he came from a farm, and I moved to the US as a teenager from Ukraine. So we had non-traditional credit histories, and so one thing led to another, and we basically said, it'd be really interesting to try to design a credit score that would be more inclusive of people with non-traditional backgrounds, students, immigrants, people with sort of strange work histories. So that was kind of the rabbit hole that we dove into. And obviously, at some point, we had a prototype score, and we took it around to people saying, hey, we built a credit score. We think it's better than traditional FICO score. And 100% of the people we talked to who were in the lending businesses said, no one will ever use a credit score unless someone's already used it. Like, right. If you want to have a new credit score in the market, you have to lend your own money and prove that this is, in fact, a functioning credit score. And so nothing feeds entrepreneurial imagination like someone telling you, oh, this wouldn't work unless you prove it. And so of course we're going to prove it. And so that's how we got where we did.
And so what was it then? Why sort of focus on the area of credit that you did? Sort of this, that wasn't really a term back then, the buy now, pay later, or pay later, the the installment kind of, point of sale type market.
Yeah. So that's where we ended up, almost through a series of happy accidents. So bunch of different things. One, I had this vague memory in college of getting a credit card at the point of sale. And I remember thinking it ended badly. It actually hurt my credit score. And I'm trying to remember why. I'm like, oh yeah, so the credit cards don't particularly want to remind you to pay your bills on time because they make money when you're late. And then you revolve anyway. And so your interest compounds and it just gets more and more expensive. And then one day you realize that you are quite a bit in debt, you're late, and your FICO score has gone down because they're already reporting you as delinquent. And so I remember thinking that was all very, very bad, except what was really interesting is that I was prompted to open up this credit card at the point of sale. And I was instantly convinced because it seemed like a really good idea. I needed credit to buy, something slightly fancier than my student wardrobe would allow. And I certainly had no money being an immigrant and a student. So the two synthesized into this idea of, well, what if you created a credit product that would allow you to buy things offered to you at the point of sale? So you are in fact prompted to buy something and you're figuring out affordability. And yet, what if we did the exact opposite of what that particular credit card did to me? So you don't charge late fees, you don't compound, you make it extremely obvious how many payments you'll have to make, and then you're done. And there's no sort of ambiguity around how long it might take to get out of debt. And so we designed this product. There was no name yet. Buy now, pay later was not a term yet, but we'd sort of imagined this product that you would see at the point of sale, you would think of it in terms of, oh, this is 6 payments or 4 payments or 12 payments. You know exactly how many dollars it would be. But that to be really a firm offer, if you will. If I could tell you, hey, it's going to be $12 per month for the next 6 months, and then you're done. One, you can charge late fees because that changes the potential total number. Two, you certainly cannot compound because that changes depending on the timeline. And most importantly, you actually have to put a total limit, a cap, if you will, on the total number of dollars the person could possibly owe. Mm-hmm. So we designed a product very much through this lens of what is the most consumer-friendly, least gotcha, least scary version of credit that you could offer at the point of sale as someone is already making up their mind how much they're going to want to spend. And when we launched with it, it was a huge surprise. We convinced a couple of friends of ours that were in the business of online retail, after the point of sale, and we would get calls the next day after we would roll it out. Our friends would say, it's kind of shocking, but it looks like I added 30% more volume overnight. Like, how is that even possible? So people seem to like this idea of transparency and expanded budgets. They want to buy more things. They can't quite afford it, or they feel like they can't afford it. They want to borrow money, but they're kind of scared and they don't want to use their credit cards because they know revolving might be something that they'll, it's a debt they'll never get out of. And so this certainty and sense of control is pretty powerful. And so that's how we designed a product, but it was almost a semi-conscious throwback to my college days when I was credit less and credit score less because I was literally fresh off the boat.
Interesting. So when did you realize that really this, it sounds like fairly quickly you found you had a popular product. When did you decide that, okay, this credit scoring thing might be a good idea, but this lending thing is really getting traction?
We were really in the credit scoring business in theory. As soon as we offered this lending product in practice, it was very clear there was a huge market pull for a product that would give people sense of control and cost transparency into credit. And we were still, so somewhere in the back of my mind, there's the business that got away, the idea of offering a BNPL credit score for anybody who needs it. But for the moment, we're very, very busy delivering BNPL to everyone.
Right, indeed. So over the years, you've been fairly critical about credit cards. And in fact, I remember one of our events a few years back, you compared them to payday loans or the payday lending industry. So how do you respond to this? Because criticism that's been leveled at BNPL because people are also racking up debt. How do you respond to that? How do you respond to that criticism as it's just another way for consumers to accumulate debt?
So there's a couple of different things that I'll peel them apart and speak to them separately. So first of all, credit cards and payday loans have the exactly same business model. In both cases, the lender, and you can dress it up with cool stories and kind of explanations of why it's different, but it's not. The idea of a payday loan is you go to kind of a weird, maybe this nouveau payday loans online are somewhat that are lit and nicer, but in a traditional world, you go to the seedy place and you say, hey, I need to borrow $100. And the person says, great, here's $100. Bring me back $200 next week. And that's it. And it's actually not the worst. It's some kind of an outrageous interest rate, but if you get paid next week and you are in fact able to pay off your loan, okay, that's fine. But in reality, what happens, you come back next week and say, you know what, I still haven't gotten paid or something happened. I need to borrow. I need to keep staying in debt. And the person tells you, oh, well, that's okay. It just doubles now. And so next week it's 400. And so you can imagine this super steep exponential curve where you're suddenly in permanent state of debt and terrible things happen to you. The only difference between that and the revolving in a credit card is the shape of that exponential curve is just a little bit less steep with credit cards because you're not doubling every week. You're adding like a few percent every week. But as everyone who finished high school knows, it doesn't matter really what the exponent is. Once you're past the elbow of exponent, it all looks vertical. So maybe it'll take a little while longer for you to get into a terrible amount of debt. But once you're in it, even if the exponent is not that high, it is still going to get you in basically a permanent state of debt. And so I believe, and I think the math proves out, that if you are borrowing money with what's called a revolving line of credit, also known as a credit card, you are setting yourself up for a financial failure unless you are so extraordinarily disciplined and sufficiently wealthy to treat it essentially as a debit card where you pay it off at the end of the month or at the end of the billing period and you're not revolving. There's another way of not revolving, and that is you create a firm schedule where you say, look, I am going to pay this $100, $5, whatever it is, in 6 payments or 4 payments or whatever number of payments make sense to you. And there's not a way to revolve. I'm just going to be done with it. And then if there's an extraordinary event and you lost your job or something happens, you can try to reschedule or you have some way of addressing it. But you are not allowed to continue borrowing and continue revolving into a larger total obligation. And that is what buy now, pay later is. And so buy now, pay later, and by the way, CFPB, Consumer Financial Protection Bureau, put out a really nice report several months ago, basically describing this as a better alternative to credit cards. I believe specifically because this is a way to borrow money without revolving. And so I very firmly believe that if you're going to borrow $1, you're better off borrowing it using BNPL than using a credit card, unless you have the luxury of just being able to pay it off freely whenever you like.
Right.
Huge percentage of US households revolve. I think something like, or it's definitely over 50%. And it is a massive source of debt on the US consumer. By the way, what makes this is not true for the entirety of the BNPL industry, but it is true of Affirm. One of the ways credit cards make money, in addition to this revolving exponential cost, is late fees. Late fees are a massive source of profit. And there's now a very concerted campaign by the Biden administration and CFPB itself to drive what they're calling junk fees down to as low a number as possible. But it is as high as a 20 to 40% of the profit of the credit card industry just comes from various kinds of fees, especially late fees. And so Affirm is a particularly honest and good for consumer exponent of this non-revolving borrowing, but pretty much any buy now pay later provider is a non-revolving lender, which is much healthier for consumers. So that's sort of the difference between cards. And the payday lending comparison, I think, is very fair, although maybe slightly scandalous. In terms of the criticism around, well, just another way for consumers to borrow money, it is. Consumers need to borrow money. Borrowing in its best form is an investment in your own future. Like, you know that you have earning capacity that you will get to in a form of a college degree. You borrow money for a student loan. That's what I did. And once I paid it off, I felt the trade was exceptionally good. I ended up with a computer science degree and lots of good things came from that. And so borrowing and credit are a good thing. Debt and being in it is not a great thing. It is really important to manage your debt as well as your credit very carefully. BNPL is a safer tool. Between the two tools, credit cards and buy now pay later loans, credit cards are a little bit like a power tool and the safety is permanently off. Like, it's very, very easy to get in trouble. BNPL is a safety first type of tool. The thing that is worth highlighting, and this is another thing that CFPB is very engaged in, and we are certainly excited to be in conversation with them, to make sure that consumers do not overextend themselves in both buy now, pay later and all the other forms of borrowing. That's why credit reporting exists. And so today, majority of buy now, pay later providers, Affirm is an exception, but majority of buy now, pay later providers do not report borrowing results, what's called furnishing information about installment loans that we do to the credit bureaus. Affirm does for a percentage of our loans, but not all of them, depending on type. It is absolutely important for the industry to standardize on a type of credit reporting to make sure that these loans are visible to the rest of the industry participants. And once we get there, which I'm confident will happen quite soon, I think it will be harmonized with the rest of forms of borrowing that the consumers can do in this industry.
Right. Yeah, I agree. That's really important. So just run us through then the different types of lending products that you have, and just, maybe you could sort of talk about what sort of the growth areas for you within that product suite.
The products that we offer today are all kind of variants of this idea of an installment loan. Some of them are quite short term. Like what's the buy now pay later term really came to describe these 4 installments, interest-free loans to consumers. They're typically really good for modest amount of money, like $200, $150. They don't really work very well above $300 to $400 because at that point, if it's too much money to pay $400 upfront, it's probably too much money to pay $100 every 2 weeks. And so what we do is we offer both very short-term, 6 weeks, zero interest products. We also go as far as 6, 12, 18, 24 months, et cetera. Longer-term products that are designed to help you finance things that are a little bit more expensive than just a couple $100. And some of those are interest-free. And in those cases, the interest is effectively subsidized by the retailer. And some of them are interest-bearing, where consumer actually pays the cost of credit. In all of those cases, there's no interest. But when there is interest, it's always, always, always no late fees, no deferred interest, no compounding. And the interest is always capped out to a specific number of dollars, which goes down if you prepay. Majority of the industry likes to penalize you for prepayment. We actually reward you for prepayment because we think it's a really healthy financial behavior. And so we typically divide it into longer terms, shorter terms, zero interest or non-zero interest.
Right. And in the early days of the pandemic, we bought a Peloton in our family, and we financed it through a firm. Was interested to go through that process with you guys. It was very easy. And then Peloton suddenly became this massive part of your revenue. Can you explain the economics there and how? And obviously, no one really saw the pandemic coming, and no one kind of expected I'm sure Peloton didn't expect their sales to jump so much. But how did they become such a big part of your business?
When we went public, we disclosed that they were over a quarter of our business. So they were definitely they still are a great partner of ours and a huge part of our success story. At this point, we've grown quite a lot. They are less than 2% of our business, last I checked, and they're still a significant source of volume. The way that particular product works is really, really compelling. For a consumer, as you've experienced, it's a pretty unbelievable deal. You are buying something that's thousands of dollars, and it's exactly the same as cash, but you get to pay for it either, I think it's between 24 and 36 months is something along those lines. The way that works is Peloton is what's called a vertically integrated merchant. They manufacture their own bikes, they package them, they sell them, they deliver them, et cetera. And so the margin on the hardware is pretty significant. And to eliminate any consideration or any thinking too long on your part before pulling the trigger on buying a really nice bike like that, they're essentially saying, you know what, we will pay what you would have paid in interest. So we will compensate Affirm for our cost of capital, cost of data, cost of servicing, et cetera, so that you get to basically have exactly the same bike for this exactly the same price if you would have paid cash, just so that you don't have to think about interest. And this really is a good highlight of how BNPL can be so much better than credit cards. If you were to buy a Peloton with credit cards and revolve, you're looking at thousands of dollars of principal. It is entirely possible that depending on your credit and your credit card rate, you may be paying thousands of dollars of interest too. And so not doing that is a pretty powerful story. And we obviously helped each other grow tremendously through the pandemic.
Yeah, no, it was very compelling because it's just, I think we're paying like $62 a month, and it was over 3 years. And it was, it was just a no-brainer, the same price up front, or, it would barely even notice it when it's that small of a monthly payment. But I want to talk about other deals you've done, and you've signed deals with both Amazon and Walmart. Basically the two biggest retailers in this country, probably the world for that matter. Can you just tell us a little bit about both of those relationships and how you're growing them?
I think obviously I can only disclose so much about some of the largest partners that we have, but the reason we won Peloton all those years ago is the same exact reason we won our partners at Walmart and Shopify and Amazon, all these huge industry participants. Ultimately, the competition is quite stiff. There's plenty of people who are offering buy now, pay later products. Some compete with some of our products. Others try to compete with most of them. But the punchline is no one does the three things that we do as well as we do. Number one, we are really a consumer-centric product experience. We take great care of the consumer. Our net promoter score always stays extremely high. We don't charge late fees. That adds obviously to our appeal to consumers. When they misstep or just forget to make a payment, we don't penalize them for it. And so that pro-consumer stance, or as Amazon sometimes calls it, customer obsession, that's something that we really share with all these companies. And they're all very, very much obsessed with the consumer experience. So that's really part one. Part two, we did invent that score, and we have iterated on it now for over a decade. It's actually 10th version as it happens. We just released the next 10th major version of the new credit score that we invented. And it does allow us to include and approve more people. And so on average, we end up approving more consumers and offer them safe access to credit without having to make money on the sly with clever tricks like late fees, and et cetera. And so that is important. That keeps us in consideration set with all of our partners. And then three, we are a technology company first and foremost. If you are trying to convince somebody as huge as Walmart or Amazon or Shopify to partner with you, one of the tests you have to pass is, all right, what happens if you are servicing Black Friday PlayStation 5 sale at Walmart.com? Better be able to keep up. If you stumble, you are going to cost the world's largest retailer hundreds of millions of dollars of lost sales, and that's not okay. And so being able to deliver on the technological promise or technological requirements that come with these contracts is really, really important. And we, had the privilege of being co-founded by 4 computer scientists. That adds up to a pretty good engineering team.
Right, indeed. So I was looking through your earnings report, your most recent one, and looking at the fourth quarter, delinquencies came down, it seems like. I'm just curious about how are you creating lower delinquencies, and what do you feel the consumer, like all this uncertainty people are talking about, the consumer lenders, this is going to be a real test because there's going to be a potential downturn this year. I mean, how are you kind of adapting your credit models for this?
So we didn't just have a sequentially lower loss quarter. We also had our highest quarterly gross merchant volume. So we grew the company while reducing delinquencies and losses. And so in that sense, I think what we're doing is we are trying to prove to our supporters and a little bit to our naysayers that the story of, well, you can only be a great provider of consumer credit in the boom times when everything is just perfect. Maybe that's true for some players. And I'm fond of quoting Warren Buffett when the tide comes out, who's swimming naked. We are trying to show and continue to show that our underwriting chops are better than the industry. And so that is a direct example of those underwriting chops in our falling delinquencies. So I think that's, obviously we will pass the test once whatever downturn happens is here, gets through, and is behind us. But so far, I think we are doing significantly better than the industry. In my letter, you can actually see, I think in Michael's section, as a matter of fact, and you can see a slide comparing us to a bunch of credit card issuing banks, all of whom are now starting to build up reserves and reporting increasing delinquencies while we are reporting decreasing delinquencies. Mm-hmm. And so, so far so good. Obviously, credit takes very, very active management. We do have a really powerful structural advantage. It's actually twofold. One, we approve every transaction, which means that sometimes we get to tell consumers, hey, you're overextended. Please do not borrow anymore. This is more money than you can safely afford to pay back. It's not the nicest thing to hear, but we are very crisp and try to be compassionate about it. But if we believe the person is overextending themselves and cannot make the payments back to us, we will not lend them money. We have no incentive to do so because we don't have late fees, et cetera, et cetera. When they can't pay, we actually just lose money. And so that's a really important component of our business. And the other one is that majority of our volume is very short term. And therefore, as we watch consumer behavior shift, and we did see quite a lot of fairly turbulent shifting in consumer demand, especially through the last few months of the calendar year, as consumers were combining or trying to make sense of buying gifts for their family, but also deal with inflation and increasing prices of commodities, et cetera. As we sort of witness what's happening in the world, we can adjust our underwriting standards to match everything from employment rates to shifts in demand, and make sure that we don't overextend these consumers.
Mm-hmm. Mm-hmm. Okay. So I want to talk about the workforce reduction that you had earlier this month. You announced 19% of your workforce is going to be laid off. How are you going to continue to grow with far less people?
The scale of the opportunity and our ambitions are unchanged. That should go without saying. We're still planning to take over the world in our own special way. We did front run quite a lot of our ambitions relative to our revenue production, just like majority of the Silicon Valley did in the somewhat crazy years of the pandemic. And just like a lot of us, we decided to reduce workforce to match our revenue production to the scale of the company. That said, it does create a certain discipline. And by the way, I'm responding in a staggered fashion because it is still an emotional thing for me, and it sucked, and I hope to never have to do that again.
Right.
But it does create a certain sense of scarcity of resources and forces you to think about doing more with less, and really puts a finer point on prioritization. It's very nice to say, well, I have all these engineers and I want to do A and B and C. It would be really wonderful to do all these things concurrently. In a world of 20% fewer people, you better know what's more important, A or B or C, and then you prioritize it. And you don't really have so much a choice of, well, let's just do it all at the same time.
Right. Got it. Okay. So you've mentioned the CFPB a couple of times, and they've certainly taken an active interest in BNPL. Sounds like from what you're saying, you're pretty optimistic that what the CFPB comes out with is going to be a positive, for Affirm anyway, but maybe even for the whole industry. What do you think? What do you expect from them?
First of all, I'm a big fan of CFPB and their mission. I spent a few years on their advisory board a bunch of years ago now, but generally speaking, we like folks from CFPB. We frequently hire them. Our first general counsel came directly from CFPB to us, and so we have a lot of kind of a DNA linkage to the folks that are trying to be sheriffs of the fintech town. So I think that's probably the origin of my goodwill towards the agency. I think, like any rapidly growing market, thoughtful regulation is a really good idea. It allows the participants to kind of know what the rules are. It allows folks to work together, even if they're very competitive. For example, CFPB will naturally take a leadership role in figuring out standards for reporting credit, which I think is really, really important. Our credit system is built on the idea of transparent reporting of positive and negative credit results. And CFPB has a great role to play there. So I expect them to continue learning about the industry. I think they've been very thoughtful. They surveyed the industry quite actively. Obviously, all of us in the space gave them a ton of data. They're, from what I can tell, certainly not done. It is not my place to prognosticate what they'll do next, but generally speaking, so far, the engagement has been productive. They have been very thoughtful in their questions. They are not scared to learn, which is always very, very important as you're trying to figure out how to regulate a new industry. You really have to be willing to not just say, well, it looks like X, so we do Y, but also say, like, how is this thing different? And the report really speaks for itself. It sort of opens with this passage describing how BNPL is profoundly better than credit cards, which I think profoundly is my word. They just said it's a better alternative than credit cards.
Right.
Put words in their mouth.
Okay.
I happen to think it's profound.
Yes. So we're almost out of time, but two more things I want to ask you. I know you don't like the term mafia, but much has been written about the PayPal mafia, of which you obviously are one. But there's becoming now an Affirm mafia. It seems like a lot of fintechs are being started by ex-Affirm employees, companies like Resolve, Peach, Centrelink. We've had all those companies on our podcast. How are you fostering entrepreneurship within Affirm?
I think fostering entrepreneurship is actually a little bit of a fool's errand. Maybe a slightly controversial opinion, but I have a view that not everybody knows they're an entrepreneur, but if they're exposed to entrepreneurship, they either think, wow, that's like the crazy lifestyle. I can never put up with that level of ups and downs. Or you feel like, wow, that's just extraordinary. Like, I want to tell myself what to do, and I don't want to take too many cues, and certainly don't want to hear about any random you can't do this or why. And so those kind of people are naturally attracted to startups, and Affirm, even being publicly traded and 10 years old, is still very much a startup. And so once you're within one of those companies, if you are an entrepreneur at heart, you very quickly discover that that is what you want to do. And the one thing that we did at PayPal, and the one thing we certainly do at Affirm, is when people tell me or tell their peers, hey, I'm kind of thinking about starting my own company, we don't jump at that person with a, how can I talk you out of this? We actually say, wow, that's amazing. Like, we need more entrepreneurs in this country. Like, it's profoundly important for the US economy, for the world economy, to have more entrepreneurship. And so insofar as this person wants to stay here and continue learning, of course, we'll support them and do all the right things by them. But as they choose to eventually walk out the door and hang up their own shingle and start a company, we are very supportive. We try to maintain an alumni network. Affirm sometimes, or I personally sometimes, take an investment position in these companies. And so we're very supportive of folks that say, hey, I am interested in starting my own company, especially if it's in the area of fintech. Inevitably, we end up being interested in those domains, and sometimes even partner with our former teammates.
Mm-hmm. Okay, so last question. I want to gaze into your crystal ball, if you would. I'd love to kind of get your vision for what will consumer credit look like in 10, 20 years time. And I imagine you'll obviously, your firm will be at the center of it, but I'd love to kind of get your sense of what will it be like from a user experience perspective.
It's always too easy to imagine the world 20 years from now, because no one's going to remember your prognoses. And so I feel like that's not enough of a challenge. I think the right challenge, and maybe this speaks for the 20 years from now, but I think 3, 4, 5 years from now, I certainly intend to be very focused on BNPL on a card. I think cards with magnetic stripes or chips or RFIDs built in, whatever the transmission mode, is still the best user interface. Even the NFC wallets within your watch, within your phone, are just pretty good approximations for pulling out a 3 by 1.5 piece of plastic that you can just tap a card reader and move on. And I think the fact that no one has cracked these really simple, transparent, close-ended installment loans on a card is just a giant opportunity. Obviously, I've spoken plenty about our attempts to do this with our product called Debit Plus, which we've certainly taken our sweet time developing, because it is a completely new mode, and getting it right took some time. But I'm very, very excited about that. I think we will still be using cards even 20 years from now, just because it is such a powerful user interface. And it may be, I mean, there's some crazy world where the chip can be like embedded in your nail or some part of your anatomy, but I don't think so. I think cards are actually pretty powerful. We've been carrying around dumb wallets for a very, very long time, and I don't see a very strong reason why we'll completely stop doing that. But these tiny little pieces of plastic are very powerful when combined with an intelligent app. And I think we'll have, some, just to nod to the current hot thing is all kinds of conversational AI. I'm not sure I need to converse with my AI about financial health, but I do want something resembling the smartest possible financial advice in an app that speaks to my card. And so as I tap my card or chip it or swipe it even at a grocery store, I want my app to say, hey, the smartest thing to do with this bill is to turn it into a loan and pay for it over 6 weeks, because the retailer in your basket is subsidizing all the interest. So you'll never pay a penny. And there, of course, will be no late fees. And we're going to route it to the bank account that we have on file. So you have to do nothing. And if you want to change it, please do. But if not, this is the smartest financial decision you can make. And so generally speaking, 10, 20 years from now, I see more and more financial intelligence pushed into smart defaults. Like right now, we agonize over choosing the right mortgage rate and choosing, what exactly is the points you want to pick up. All these decisions are just designed to confuse and ultimately profit the lender. I think a lot of that will get washed out with some form of intelligent financial assistant that you can trust to do the right thing for you.
Okay, we'll have to leave it there, Max. That's going to sound like a fascinating future, but appreciate you coming on the show today, and best of luck.
Thank you.